Happy Sunday. Welcome to my YouTube channel, Elektronfx Academy. Right, so this was a promised video. I promised to share this, right, to help intraday traders to learn how to manage your trades and learn how to affect their trade. So this course today will be divided into 3 basic sessions. Number 1, how to determine daily bias, and then intraday trading. Intraday trading, right, based on daily bias. These are the basic things we're covering in this session, right? Now, if you have not subscribed to this YouTube channel, please do subscribe, hit the notification bell so that you can get updates when we post new things, all right? So now, when we are talking about when we talk about daily bias, what do we mean by that? Now, I would like to just make certain points. Now, before you actually call yourself an intraday trader, there are basic things that you should know. Number 1, what is intraday trading? Intraday trading is a kind of trading system which has a maximum time limit of 24 hours. What do I mean? I mean that when you're trading intraday, it simply means that your trade should not exceed 1 day, or let's say that's most 24 hours. That means you're trading in between 1 minute, 2 minutes, 3 minutes, 10 minutes, 2 hours, 3 hours, 4 hours, 6 hours, 10 hours. But the point is that it should not exceed the day. That means the daily candle is very important to you. Right? That is why you have to understand intraday trading, because your trading opens and closes within the daily time frame. Or if you should exceed, maybe if you got into a trade by maybe 11 p.m., that is from 1 hour to the next day, then it's still intraday trading as long as the trade does not exceed 24 hours. So we can categorize trading systems based on time and based on approaches. So based on time, we have what we call the intraday trading. That means the trading does not exceed 1 day. That means the time frames you use are between, these are the time frames you use for trading. It means you use 1 second, 2 seconds, all these time frames highlighted there, apart from anyone that exceeds 1 day. That means your interest is from 1 day and what's below. That's what basically intraday trading is. Then we have the scalpers. Scalpers basically they just use few points in the market. That means if the scalper gets into the market, he's exiting the market in maybe few minutes, few hours. But the point is that he's just trying to get some points, right? A scalper usually he use big lot sizes, right? Maybe can get in the trade around 103.2, and maybe the price gets here, right? The scalper can just basically trade from this point to get some points. Right? Can trade from here. Maybe he buys it. Once the price gets here, it's closed. So the scalper basically use huge lot sizes and just look for little points, right? So I don't encourage this, unless maybe you enjoy it, but I encourage that most of you should be intraday traders. Then after the intraday traders, we have what we call the day traders, and then we have what we call the swing traders, and then we have what we call the position traders, right? Those are the investors, right? So I'm here to talk about the daily bias. Now, when you're talking about daily bias, we are trying to know one thing, just one thing. You want to know if the current D1 candle is going to buy or it's going to sell. That is your focus. You want to know if this candle, the current D1 candle, is it going to buy or is it going to sell? That's what basically what it means, right? So let me go to the chart now. So when we talk about intraday trading, right? Look at this. Let me bring the replay so and take it to here. Yeah, okay, yeah. Let's take it in. Now let's look at this candle. Now imagine that you are trading. Right, so sorry, jump. So let me get something. Now let me just play it a bit. So let's see something. I think I missed what I was looking at. Okay. So that is it. No, let's take it back a bit here. Just there. Right. So although we have seen what's happened, right? So now, what do we mean by daily candle? What do we mean by daily bias? Now, when you are trading a daily bias, the daily candle is your candle of interest. That means the current candle is your candle of interest, or the next day. I'll say, assume that this was the day that you came and saw the chart, you saw this candle, right? And for a daily bias, you want to know what's the next candle will look like based on the previous candle, right? So you're looking at this candle. Let's look at the structure of this market now. So look at this market now. We had external liquidity at this point here. We had liquidity up here, right? We had liquidity around here. We had liquidity at this point here, right? Forgive me if you don't understand liquidity, go and watch my video on liquidity, right? So if you want to do that, just go to my YouTube channel and just search liquidity by Elektronfx. You will find it. I talk about liquidity there. I just search Elektronfx liquidity. That's all. So look at this chart now. We had liquidity to this point and down to this point. As you can see, market was actually bullish. What do you mean by market was bullish? You could see a series of higher highs, right? Higher low. You could see this higher high here. You could see this higher low. So because the market was giving a bullish tone, although it gave a kind of false break, but it did not actually be because went above. So we could have higher high, then we have our higher high here, and then our higher low, and then a new higher high. So you can say the market was bullish, and in the bullish market, you expect the market to take out what the buy stop liquidity. I mean, in a bullish market, expect the price to take out liquidity to the upside. That means when you draw your range, you expect the market to take out what the upside liquidity. Market should not take out the lower liquidity; it should take out upside. That's what we expect in the bullish market. So now we have established that we're in a buy market, and whenever market takes out liquidity, it usually retraces. So market has taken out this liquidity, and now look at what happened. You can see that this candle, you see that the buyers were in this market, but they could not push price further up. And then you could see the next candle did was look what the next candle did. Look closely. Look what the next candle did. The next candle, what it did. After the next candle printed, look at this. So this does bring an arrow to illustrate this, so you get this point, right? Now look at the next candle. The next candle did what? It's bought, and look what the next candle did. This next candle took out the high of this candle, right? It took out liquidity here. That means anyone that was trying to sell with this candle wick, right? Maybe you saw this rejection wick, they would have been stopped out. So market took out this liquidity, took out the wick, because wicks are usually liquidity. Daily candle wicks are usually liquidity. So market took out the upside liquidity. Now, what do you think the market is going to do? Since the market has taken out the upward liquidity, what again is the market going to do? Because market is drawn from one liquidity point to another. So since the market has taken out this liquidity, there's no point for this market to keep buying anymore. Because now, after this liquidity has been taken out, that means the sellers have been taken out. What's next? The market is going to go for the sell side liquidity or the sell stop liquidity. Since they're taking out this upside, the next obvious place is what? This lower wick, right? So market has taken out the upper liquidity, taking out this one. What do you expect? The market to do was to come and take out the lower liquidity. And not only that, remember that in a bullish market, you expect the market to do what? To make what? Series of higher highs and what? Higher lows. I mean, the market has to retrace to form what? A new higher high. Now look at what the market did. The market has done what? Giving us higher high, higher low, new higher high. What do you expect? The market to do was to drop, to give what? A new what? Higher low. So since you are combining market structure and concept of liquidity, the market gave a higher high, higher low, and then a new higher high. Now, based on the structure of a bullish market, after the market makes a higher high and takes out external liquidity to the upside, it has to do what? It has to come down to form a higher low. So we're combining market structure and liquidity. So now we have seen that the market has taken out the last high, and now it has taken out this liquidity too. So what do you expect? The market should do what? Should come down to form a higher low. So this now gives you your daily bias. So your daily bias based on this liquidity sweep, we are expecting a bearish market in the next day. So based on this, we can say that market has taken out liquidity, give us a new high. We should expect what? A bearish market. So you expect the market to do what? To dip. So this, let me tell you, this candle alone, this one candle alone can give you so much profit if you know what you're doing. So when you're intraday trading, you are not concerned about catching the daily moves. You don't start catching the day. Like from here, let's measure this. If because you buy around here, the buy would have been taken about let's say about 16 days to play out. So you're not interested in catching trades for 16 days. You're not interested in catching trades for a few minutes to a few hours, right? So now you can see that the market is taking out liquidity to the upside, and now the market should come down to form a person. So now you have combined market structure. I have combined what? The concept of liquidity. So now where is the next target for liquidity? Look at it here. So market is taking out this upside. The next target should be where? Here. This next week here. Which other targets? This week here. This week. The next target this week. This week here. This week. This week. So that's what the market is likely going for. But so since it's a bullish market, we're not expecting a major deep retracement. So we want to just catch this at least with the 50% of this move. So you can bring out our Fibonacci tool and do what? You measure from swing high to swing low. So you want to catch this at least to 50%. I want to sell the market at least to somewhere around there, maybe 50% of this market, right? So you know the market has much room to sell. The market is still very far from the 50% Fibonacci level, right? So that means the market has a lot of way to go if you are trying to sell this in an intraday setup. So now when you have identified your daily bias, now you go to the next candle, and this is where I want to teach you about something. Now, in every candle, in every day one candle, I want to explain this. I learned this from Michael Hudson. Shout out to Michael Hudson, the founder of ICT, the inner circle trader, right? This is a concept I learned from him, right? It's not wise to teach a concept and not give due honor to the founder or who brought the idea to light, right? So shout out to Michael Hudson, and God continue to bless, right? So now when we are talking about a day one candle, we should expect three things in the day one candle. We should expect what the accumulation, the redistribution, and the manipulation. What do we mean by that? So when you bring out, when you look at your candle, there are three parts of a candle, of a day one candle, right? So you should have this. Then we just bring out this. So in a daily candle, we have this, right? We should have this, right? So we have this in a bullish candle, right? So you should see this. Market opens, if it's a sell candle, market should open here, somewhere around there, right? Then you see something like this. I will explain this in a bit. So basically what you should see, right? So let's go to the bar chart. You see it actually looks like what I'm talking about. So if you go to the bar chart, that is basically what I'm talking about. Just this. I'm just going to explain this thing you're seeing, right? So now what do I mean by this? So in this stuff you're seeing here, in every D1 candle, there is these three components: the open price, the manipulation, and then the close price, right? Those are the basic things you want to know. So if you are having a sell bias, when you're having a sell bias, you want to catch this market after it makes what is manipulation. So for a sell candle, for the market open there, so let me just highlight that so you understand this clearly, right? This is a very deep concept, right? So this is the open price of this candle. This is the open here. This upper one, the left side, this is for a sell candle, for a bearish candle, right? It's for a bearish candle. You see the open here. This is the open, this upper side, according to the bar chart. Then we have what we call the manipulation. So this up push here, like this push, like look at this week, the market opened there and then pushed up. So this week, I see this push up, we take a look at this, what we call the manipulation, right? So for a bearish candle, or if you're having a bearish bias, you want to see that manipulation, right? You want to see that open and then the manipulation. That means you want to see that false move. So this area here, this from this open up towards, from this open towards this week, like from this open to this total liquidity, that is also called manipulation. And after the manipulation, the market should do what? Should sell down. And then after it sells down, you know, the market will come and do what? Come up a bit and then close. Usually, market does not usually close where it got to the slow. It's going to form a slow and then close, right? So that is a close. Right. So this is the close of the market. Look at this. Let's understand this, right? Look at it. The market did was open there, gave its manipulation to the upside, and then look what happened. It's sold down. This is the body of the candle. This line now, this space is what we call the body of the candle, right? And then you can see what the close. The market actually wicked it down, gave its lower manipulation, right? And then wicked down. So for a bearish bias, we are concerned about just three things: the manipulation, the open, and then the body of the candle. We want to catch the sell from the manipulation aspect. Once the market open, manipulate, and then come down, right? So these are the basic parts of a daily candle or every candle. So you can see open, manipulation, sell down, and then close. So when we are trying to catch a daily candle, we want to catch what? The manipulation. We want to catch the market after it has manipulated, or if you're smart enough, you want to catch the market to do what? To when it has finished manipulating, and then you cannot catch the sell down. That is the daily bias. Remember that the daily candle of the current day or maybe the next day is your focus. That means you're planning to trade today, then the daily candle of today is your interest. If you're planning to trade tomorrow intraday, the daily candle of tomorrow is your what? Interest, right? So now you must always look at the bigger time frame perspective. What is the market doing on the bigger time frame, and how can I catch the move for what today? Although this is a bullish market, but market has obviously captured all the liquidity. So what do we expect? The market can do is to drop down. So now we have our open, close, and manipulation. So now, seeing this, I expect this market to do what? to do what? To keep selling down. Why? I want to show you something. Now, look at this weekend. Market has not cleared this second liquidity. Follow me, please. Don't be lost. This is a very deep concept, and this will change your trading forever. So now look at this. This market has not cleared this liquidity, right? It has not cleared this stuff. That means I expect the next daily candle to do what? To still do what? Open, give its manipulation, and then sell down. So for the next day, I'm expecting a more bearish move because this liquidity has not been captured. And not only that, we have imbalance. There's an imbalance from year to year, right? There's an imbalance here. An imbalance here, right? So let me go to my template and then choose imbalance. So there's an imbalance here. Market should sell down, clear liquidity, and then come to feel what? This imbalance. So now we have a bearish bias because the market is giving us what? A sell setup. So we are looking to capture the sell after the open and what? The manipulation. Now we have understood the daily bias. How do we do our intraday trading? It's also now when I come to what we call market structure. So let's look at what happened on daily candle. After that happened, let's see what happened after that. Let's see. Let's play a bit. So look at the next daily candle. Let's watch what happened next. Wow, can you see that? This was very beautiful. So let me kind of slow it down a bit. Let me slow it down a bit and then take price back to that point. Look at how I was able to predict the daily bias. So look at it. So we had that candle. Let me reduce the speed a bit. So we had that candle. So that candle printed. What happened next? You see the next candle. Look at it. I see how beautiful it happened. You can see it. Have you seen what I just explained now? Have you seen that? What I just explained now? Just what I explained. That using the daily bias, we have identified what the market is most likely going to do in the next day. And then we can see that market did exactly as I explained. This is just daily bias, knowing what the daily candle is going to do because you want to do what? You want to do intraday trade. Now, so we had what? See the next candle that happened. Look at the next candle here. Look at it. Let's look at what happened. It was an amazing bias. If you understood it, look at it. I told that in the next candle, you should expect what? The open, what? The manipulation. That means the market opened there. See this week. This week, the upside is also called the manipulation. And then look at what the market did. It came down and cleared this liquidity and came into our imbalance. This is how you use daily bias to organize your trading. So for this day, you should be looking at for only sell opportunity. You shouldn't be buying this market. You wait for the market to open and then to do what? To manipulate. The market to do what? To push up, right? Maybe to fill in inefficiencies and all of that. And then you do what? You sell that. So let us look at this market. Since we have gotten the daily bias, let us see how we would have gotten into this one. Forgive me, my replay tool is not allowing me to do intraday, but I don't know. I've not kind of I don't know what happened to my premium trading view. It's not kind of showing lower time frame. So let me just box here up. So I will see. Let us box from here to here, so we can see how we have caught the trade here. Right, looking at only this point, right? So now let's go to our 4-hour time frame, right? We have gotten the bias of the market. The next thing we're looking at for is what? The market structure. So this is what we're looking at for. This was the whole candle, right? So I'm trying to look at for the new day. All right, so this was a new day, right? So from here, this was a new day. Like this was the beginning of the day, right? From here, from 12 p.m. Yeah, from here. So this is the whole daily candle, right? I told you that you expect what? A manipulation and what? An open, a push up. So this push up is what we call the manipulation, and then the close. Now we have understood that. Now look at what happened there. Now we have understood the daily bias. What is the next thing we look at for? We look at for the daily the 4-hour or the lower time frame structure. Remember, you must always identify structure after identifying the bias. You don't just trade sell because you're expecting a daily bias to sell. You have to look at the structure of the market that corresponds with what your daily bias. So let's look at this market closely. I can see beautiful stuff here. Look at this. We have what? We had a higher high, a higher low. Please, if you don't understand this I'm teaching, go to my YouTube channel. Just type market structure by Elektronfx. You will find out too. Let me see if I can do that now. Market structure. You find out on YouTube actually. All right. So let me just try if it's on Google. All right. Elektronfx. Let's see if it's there. All right. Let's see if it's on Google. Wow, it's there. Amazing. Can you see it? It's already on YouTube by Elektronfx Academy. So just type market structure Elektronfx. You will see them. You see my market structure videos, right? You can always see them. Just click on view all. You will see all my videos on market structure. I've made more than 5 or 6 videos on market structure. So It's very easy. Just come to Google, you'll find it and all of that, right? So that is that. So let's go back to what we're doing. So now we have identified the higher high, the higher low, the higher high. And look at the market, what the market did. Look at this. Just look carefully. Follow me. Now, this market did what? Sorry. This market did what? After the market gave that bullish run, we saw what? A liquidity sweep and then what? A break of structure. What do I mean? Look at this. There was some kind of what liquidity was resting here at this point here, because after the markets came here, there was a kind of retraction to the downside. Look what happened. The markets used this week, cleared liquidity, and then gave us a break of structure or a change of character. Please watch my video on POS if you don't understand that. So there was what a break of structure at this point here. Now it is aligning with our daily bias. Remember, you're looking for a sell today. Right? You're looking for a sell. So now we identified that was a break of structure. Now looking at this, where should you be looking at for sell? Remember that the market will open and then manipulate. You want to catch yourselves from the manipulation or after the manipulation, so you can catch the sell down. So look what happened. The market get that BOS. Where would you have been looking for yourself? Obviously, you are looking at for what? This last buy candle. This last buy candle will have been your area of interest. This last buy push, your order block, right? So this is the order block, right? And why is this an order block? Remember, look at this. There was an imbalance created here. Look at that imbalance here. So let me just use a vertical line to mark the open. So this is our open from here, right? So let me calculate the day this. So I can know this is the day we're looking at. So this is here from this day. This is the beginning of the day from here, this candle here. So now we had what? This was the last bullish candle before what? The break of structure. So this was a kind of interest. Why? Because you could find what? An imbalance. So look at an imbalance. So there's an imbalance between here and here. So the imbalance here. And look at what happened. The markets came into that imbalance and then did what? Sold nicely. Look at it. So look at it. We had what? The last buy candle before what? The break of structure. And then look at what? There was an imbalance here. So the market was going to sell it. So now when you have your imbalance, what do what? You're not looking at what? This is the area of interest. From this imbalance, right? This is the area of interest for what? This imbalance up to the high of this candle. So you want to sell in between this imbalance or the open or the swing high that's above this week, right? So now you have gotten the 4-hour area of interest. Now what do? You go to your smaller time frame to get your good entry. So you come to your 2-hour time frame. Look at this. Now look at 2 hour. Look at this. So now on the 2, let's go to 1 hour instead, right? 1 hour, let's go to 2 hour. All right. So look at this. We went to our 1 hour time frame now. Look at it. We want to see how we have got our entry, right? So look at this. Now this is the open of the candle, 12 a.m. So we had that manipulation. So we had our imbalance here, right? So there are 2 ways we have played this, right? The first way we have played this is number 1. We have played what? The feel of the imbalance. And where is the feel of the imbalance? Just here. Look at this clearly. Here. See where that week. This was the last week before the sell move. So if you place your sell limit at that field, this is the first way we have played this. So you put your sell limit at the field of the imbalance. Maybe stop loss above what's the week. Look at what we have made. We have made a whooping. See that we have made a good. Sorry, it's from here to here. Sorry. This was a new day. Sorry. So it's if you use that. So your sell here, and then your stop just above what's the week, right? The higher week, or if you are conservative, you have just played what this week here, just here, this point here. These are the 2 ways that I played it. So if you played just this week, because the market should not get above it because there's no imbalance above. So if you played here, just above this push or just like above this swing high here. So let's see. If you played here, right, just above here, if you play the imbalance, just at this field of this imbalance, just here at this week here. So your stop loss above here. What would you have made? You have made 1:2.62. What would you have made? Right. So now let us look at this. Was using a limit entry, right? So just playing limits. Now let's look at if you used a break of structure on lower time frame. That is what we call evidence of redistribution. So now let's look at the structure of this market. So we had was this is how we also would have played if we were using break of structure on lower time frame. So you have seen that we had what? A higher high, a higher low, a higher high, and then we had what? a break of structure. This is also called redistribution. Markets distribution inside your area of interest. So look at what we had our break of structure. And now, how would you have played this? So we had our break of structure. So you're looking at for what? The last buy push. And then based on what I can see, this was like the last buy candle. This one was the last buy candle, right? It was like the last buy candle, right? So where we have played, if you play the last buy candle as your order block, right? You have still gotten this. I'm not teaching the basic things because I can't really teach everything here. If you want to learn more about this, you have to join my mentorship program to learn more, right? So I'm not teaching based on what I can see, right? In a way to be easier for you. So if you play the open of this candle now, say you have made the entry smaller. So if you play the open of this candle, just the open of this last buy candle here, just here. Our stop loss were above that candle, just above it. Let's see what we have made. We have made 1:2. 1:2, right? It's a very beautiful trade. Now let's see if you played a lower time frame. Let's go to 30 minutes and see if you played 30 minutes and see how your risk reward ratio would have been. Right, let's go to 30 minutes time frame now. Let's look at 30 minutes time frame. So on 30 minutes time frame, I'm just going to show you how you can use small time frames to make your entry better, right? The smaller the time frame, the better your entry. So let's look at 30 minutes time frame. The same thing. We had you have to use the smallest time frame possible to get your entries, right? So higher high, higher low, higher high. Okay, look at a new structure now. So this give us a clearer structure. So how do we knew what a higher high here, a higher low, and then a higher high. So our breakout so actually occurred here. So I had our BOS here. So our breakout structure here. Market cleared the last higher low and then did what? Rallied or back up. So now, if I was looking at this, I want to catch my entry. I would have been looking for an area of imbalance to make my entry, right? So let's delete that. So where was the imbalance I would have played? Look at the imbalance here. There was a tiny imbalance in between here and there. Right? This one would have played just the imbalance. I've gotten a very nice entry here if you play like this, right? This was the imbalance just here. This imbalance here, right? So imbalance here. I'm showing you secrets I would have used for your trading. This is just a general entry. I'm not going to go deep because this is a free YouTube channel, right? So this is it. So you have gotten your imbalance there. This is the imbalance, right? So if you play the imbalance, you have still gotten a nice entry. That's 30 minutes give you a better entry, right? So see it here. So you have sold just maybe at the open of the imbalance, right? Just so that the open of the imbalance and your stop loss should be where either two places, right? You can put your stop loss where let me remove this. So you have put your imbalance in two places, right? Imbalance can be placed. You can play imbalance in two ways, either the range high or the above a candle of the imbalance, right? So if you are using that, so if you play this and you are playing the range high, right? Let us see what we have made, right? So if you use this, right, and your stop loss above the range high, which is this week here, what would you have made? You would have made a whooping 1:3.25. Now, if you are playing just the candle of the imbalance, right, you can play either the range high or what the above the candle of the imbalance. So if you play that, you have just put the high of the imbalance, and I think it would have been clapped if you play that. Your stop loss would have been hit. So you see why it's better to play the high. So if you play the range high, you would have made a whooping 1:3. So risking, if you are risking $10, to have made as much as triple of what you are risking, right? So I want you to just do me a favor, right? Do well to join my Telegram channel and number 2, back test. This I've just used one example. I can't do more than this, right? This is just one example using the DXY. So you can use this to back test. Look at what you should expect the daily time to do, and then you try to catch trades after the manipulation using the daily bias, right? So if you want to join my mentorship program, it's still ongoing. We have gotten a lot of students and it has been amazing. So it just goes for $70, which is 35,000 Nigerian naira. We have a harmonic course that's worth $100, but it's given for free if you join us. We have live Zoom sessions. We have live trade calls. We have a signal channel to help you to earn while you learn. We have a community of traders I have trained where you can interact and learn. You see, if you are among good traders, there's no way that you're not good because you can learn from them, their trades, and you can ask questions, right? And we have a beautiful lecture system from the scratch of trading to a level where you can make consistent profits. We teach you from scratch. Even if you have not said about Forex before, we teach you from scratch, right? So if you want to join that, just use the link in the description and join my Telegram channel. Contact me on Telegram to join and enroll, right? It's just good for $70, a one-time payment of 35,000 naira, right? So see you in the next class. See you in the next video. Don't forget to subscribe, share this video, and have a wonderful day. Cheers and God bless.